Welcome to episode 30 of Fundraising Demystified. Today, we have Frank Licea, co-founder and CTO of Howdy, a tech-enabled staffing firm that helps companies staff software engineers from Latin America. They've raised an $18 million Series A from Greycroft, Obvious Ventures, shortly after graduating Y Combinator. Frank walks us through what it's like to differentiate their offering in a highly competitive market to attract venture capital and get accepted into YC after bootstrapping the business, why and how he joined as a technical co-founder of an early-stage startup, and his strategy to securing a Series A round in a difficult fundraising market. As a reminder, to get notified of our weekly podcasts and newsletters, please subscribe at join.thunder.vc. Again, that is join.thunder.vc. Now, on to the show. Hey everyone, welcome back to the show. Today we have Frank Licea joining us today from Howdy.com. Thanks for joining us, Frank.
Hey Jason, thank you for having me.
Yeah, no, I'm excited to hear your story. Let's just go ahead and jump right in. Can you tell the audience a little bit about you and what you're doing at Howdy?
Yeah, absolutely. So welcome everybody. My name is Frank Licea. I am the co-founder and CTO of Howdy.com. Howdy.com is a hiring platform. It's focused mostly in Latin America. So if you want to hire software developers or customer support and so on, you can go to our platform where we make it happen. So we've got the local logistics for the hiring, the payroll and benefits, equipment and offices, whatever a team needs to really expand their operations around the world.
Why'd you start it? What's your background? What led you to get to that point? And, kind of tell people a little bit about your technical background as well and how that influenced your ability to launch Howdy.
Yeah, absolutely. So my journey here started around 2015 in Austin. So that's where the company is headquartered. It's where I live. And in, let's say, 2014, 2015, around those years, so a few years ago, Austin started to get really, really hot in terms of competition for talented people. And so this was a problem I experienced firsthand as an engineering leader, trying my best to hire software developers, retain them. Not only was the market getting hotter and hotter in just Austin itself, but contributing to that were companies like Amazon, Google, Facebook, Meta, all these important tech companies moving into our city very quickly in the span of a few years, driving up the price of software developers, making it harder and harder to retain them because they were jumping ship from place to place. And at the time, I was a product manager myself, so I ended up being on the hook for, I was on the hook for deadlines, essentially, for product releases, for new features and so on. And you can imagine how hard it is to hit a product deadline if key members of your team are rotating in and out because they're being poached by a bunch of other companies or a bunch of startups. When all those companies come in, it also brings in a lot of venture capital. So there's new startups, tons of frothiness and so on. And so essentially the problem I had to solve for ourselves it was a talent risk. I just didn't have access to the talent that I needed. Usually when people think about hiring outside of the US, they think salary arbitrage, but that's a really limited way to look at it. And besides, when you find somebody talented, you're going to realize that their salary expectations are going to be rivaling anybody in the US because they know that they're good. So this really was back to talent risk. How do I mitigate the talent risk? And we started Howdy essentially because I was looking for good software developers. The good software developers weren't interested in working on or putting themselves out on the freelancer platforms because finding quality teams was, at least the way they explained it to me, was pretty spotty because everybody can hire on those teams. And so you might not have the best access to the most sophisticated teams where they treat you the best. The best teammates also didn't want to go work for the big outsourcing firms, which was one channel to get access to them. Because the big outsourcing firms also, maybe they're not so tech-oriented or developer-oriented, so I couldn't find them there either. And so essentially that, the best companies in Austin also they weren't going to build amazing product teams with an army of freelancers. They also didn't want to work with big outsourcing firms because they weren't going to outsource what do we call it? Like values and culture, the engineering values and the engineering culture of Silicon Valley, right? That's something you can only find in California, or so we thought. And so that was essentially the idea of Howdy.com. It was, could we build a platform that has expertise in local logistics so that teams can recruit, hire, maintain, retain, provide offices for, provide benefits and bonuses and so on for their own teams in Latin America, so they could work with them as though as though they were just one team. So that was the why we ended up coming to this problem. We just had that problem ourselves.
And you guys chose to bootstrap the business before ever kind of chasing down venture capital, and pursuing Y Combinator. So why did you guys bootstrap it, and to what point did you guys get the business from bootstrapping it?
We decided, yeah, absolutely. So we decided to bootstrap this. Honestly, if I'm thinking back on it, I think it's because it's not particularly sexy, and we didn't. At least I didn't think that anybody would be interested in investing in a service-oriented company, right? So yes, we have software and we've got a platform and it's more sophisticated all the time, but essentially it boils down to hiring people and staffing them, and the economies of scale there are completely different than a total SaaS product. So, but we could see how profitable it was to hire one person, or when a company hired one person using our service, we could see what the margin was, how profitable that was, and we could see, okay, we can extrapolate and say, if we wanted this kind of lifestyle for me and my co-founder, then we just need to grow the business this much. And both me and my co-founder had always wanted to be business owners. We'd always wanted to be founders. We'd been burned working for other startup companies in our careers, especially here in Austin, and not really coming from that traditional entrepreneurial background. Neither me or my co-founder, grew up as teenagers being entrepreneurs or hustlers. Like you see on YouTube, where you find those people that are 20 years old and they've got a $2 million business because they've been hustling since they were 10 years old. That was definitely not us. We were definitely paycheck driven, risk reduction, and so on. So it was just the most natural, counterintuitively, it was just the most natural way for us to do it. It's not a very sexy business. We want control over the business, its growth, its strategy. We're tired of being beholden to boards and investors by the way that we experienced it being early employees at other startups. One of the worst experiences I can hear, and we try not to say this, but the company needs something, and then you hear from the founders, oh, well, I got to get this. The board says we need to do this, or I got to get this approved by the board, right? We never wanted to be in that situation. So that's why we decided to just bootstrap it from the beginning. And thankfully, after 10, 15 years of careers ourselves, successful careers, non-entrepreneurial careers, but successful careers, we had some money saved in the bank and some visibility into how much of our own personal money we'd have to use before the business was able to pay us. So that's why we decided to bootstrap it. It was kind of a combination of control and our own twisted way of reducing the things that were risky to us. When did we decide to finally take outside money and grow it bigger? It was when we got the opportunity to join Y Combinator, and I think that's what really changed the equation for us, because we grew the business to about we define success of our business by the number of people hired on our platform. And so we needed about 50 people hired on our platform for us to start to be able to pay ourselves. And when we started to approach that number, we thought, hey, this is fun and all. This is great. Like we're growing the business. We're learning a lot. We still have control over it. But two things. One, we've worked for YC companies before. We saw the credibility it lends, the visibility it can lend to businesses, the access to investors and mentors and so on. So you can see how if you have a 7-year plan, maybe through the Y Combinator channel, you can make that a 2 or a 3-year plan, right? Not guaranteed, but maybe. And then the other is it's a lot of fun to kind of change perspective where in one hand or in one view, the objective is to build a lifestyle business that pays me, my families, and our immediate our colleagues well. On the other hand, it sounds a lot of fun to take over an entire industry or an entire market, to be a huge player on two continents in North America and South America. That's a completely different ballgame. And I think, once we started to approach that growth level, once we got the opportunity to join Y Combinator, that's when we really had to pause and think about what we wanted to do.
No, and I guess, and from your perspective, Y Combinator is probably a business development as well, because all the companies going on to raise money through Y Combinator could ultimately be customers for you guys as well. Was that part of the thinking in addition to raising the capital, or was it mostly just to raise the capital and kind of change up how you guys originally thought about the business?
That's a great question. Actually, I'm not sure that for us, for me and Jacqueline, I think just being part of Y Combinator was good enough. Never mind the potential business development opportunities. However, a little bit of trivia. All all respect to all my YC companies and everything, but what we discovered is that tiny, like pre-seed or pre-product market fit companies tended not to be our bread and butter, and really very, very risky, even for companies like ours, for hiring platforms. So luckily, we never looked at the opportunity that way, and it was not an important part of our business development strategy or an acquisition channel, because it ended up being that the companies that ended up finding our services the most useful were, I don't know, maybe a little further along, maybe like post Series A and Series B companies that were big enough to see the need to expand operations in a different country, but not quite big enough that they could just do it themselves. So that ended up being our sweet spot.
Gotcha. And something we want to talk about is, you're the technical founder, you're the CTO, and Jacqueline is the CEO. I guess, how did you guys meet? And you guys kind of gave me the little founding story, but as far as coming in as a technical co-founder, that's the holy grail for a lot of founders that are trying to start a business, and they're like, I got an idea, but I need someone that actually can build it and scale it and knows the technical side. What kind of brought you together with Jacqueline, and what ultimately kind of led you? Well, we heard the starting story, but how did you guys come together and decide to work together?
Yeah, I get that question a lot too as a technical co-founder. They're like, Frank, I need somebody like you, or I need to, how do I get one? And then they have like the founder dating things and meet a technical co-founder, all kinds of tools and things like that. So for me, it was me and Jacqueline happened to work for the same company, and not at the same time. And it was actually kind of like I left the company and she joined the company, and it was, I guess, a little bit of luck through mutual friends. I think what brought us together was that we'd experienced the same problem, only from different perspectives. She was on the hook for sales quotas, but if the product team is churning people, then it's less likely that she can hit her sales quotas with the promises for new features or roadmaps that she's using to try and close deals. And then I had it from like, well, I can't build it if we're churning software teammates. As far as like, I don't know, do you get questions like, hey, how do I find that technical co-founder? Does your audience get those questions a lot?
It's I would say, especially for the early stage or they're like, do I go to a dev shop and have them build it all, but they don't necessarily have the the technical experience to manage that dev shop and hold them accountable. So, it's always, I would say, in that kind of early kind of angel, friends and family, pre-seed stage, where it's mission critical to have, someone like yourself, like a technical co-founder, to be able to be all in. And that's what a lot of investors also want to see when they're, going out raise. They want to see that box checked. So yeah, like how, what's your advice for founders trying to find a technical co-founder?
It's not easy. It's really, really hard. I'll tell you what brought me and Jacqueline together. And I think this is something that you probably want, or your audience will probably want to find or see in a technical co-founder. Jacqueline and I think one of the things that really brought us together is that how do I put it? Like we're both very interested, share a lot of the common values for what business should be, and I think that's super super key because if you're approaching a technical co-founder and they're, for example, equity split, right? So sometimes I'll hear advice like, okay, I need a technical co-founder, but I started this business and I've been working on it for a year now, a year and a half. And so if I'm going to bring on a technical co-founder, I'm only going to give them like 5 or 10% or whatever it is. And here's the thing, I probably wouldn't have joined. And a lot of the so and this is exactly what happened to me and Jacqueline. So Jacqueline had actually started the business about 1 year before me, but we had been talking about over a whole year, like, hey, Frank, I'm working on this thing. I need a technical co-founder and so on. And two things had prevented me from actually joining and jumping. Actually, three things. The first thing was that I was working for a company called Disco that was on the way to an IPO, so I wasn't going to leave that. I wanted to leave on good terms with my existing team. So set that aside. I wanted to finish my work, and I knew that was about like a 1 year project. Um, but additionally, I I was a little bit nervous about saying like, okay, here's the thing. If I am going to give up my long-standing career as a software engineer, a product manager, and so on, I'm not going to do it for a 5 or 10% equity stake in something that I'm going to completely commit my life to, bring my family in for, and so on. In addition, if it was like another smaller stake like that, it wouldn't have gotten the best out of me because then I would have given employee Frank, and employee Frank is not the best Frank. The committed, the high risk tolerance. In some form, in some twisted form, Frank is the one that needs like a 50-50 equity split. And that was almost, that was very, very hard for somebody who had been working on a company for a whole year and so on. So you can imagine that. So that would be the first thing is, are you ready to give up the kind of equity that somebody that's very highly skilled is going to need? Because you don't need ask yourself, do you really need somebody like a CTO who is going to, I hope people don't cancel me, but sacrifice family, sacrifice important events to be part of the company, sacrifice immediate financial rewards to be part of this. Because if you don't really need that, then maybe you don't need that technical co-founder, and then we can explore kind of outsourcing and things like that. So that was the first thing. Is it good? Are you willing to give enough to make it interesting? I think technical co-founders are more and more aware of being taken advantage of also because the CEOs and the business savvy people, they're very good at negotiating. They're savvy. They're charismatic. They're influential. They're persuasive. And so you can come on too strong for a technical founder. We're like, oh, this guy's too slick. I'm going to get outmaneuvered and so on. So that's one way to show that kind of a kind of commitment to a true partnership.
I'm really glad I asked you that question. I don't think enough founders do that. They think they can. They get so wrapped up in their head of like, well, this is my company.
Yes.
And albeit maybe they still remain the decision making power, but like there's got to be some real value on the table to, especially because engineers have options. They can Google will snatch them up. Like all the big brands will snatch them up at any time and pay way more than you could ever pay, and the probability of success is much lower with a startup and so on. And I think founders don't, especially on the business side, don't respect that enough. And have these types of conversations with technical people that could bring the kind of value they need to go out and actually raise capital. Because I can tell you, someone that helps people raise money, if you are if there's no technical founders and you're building a tech company and you don't have the tech yet, and or it's all the money's going to be going to a dev shop, it is incredibly hard to get institutional money at any point in time. You might be able to convince some buddies, but even those buddies are probably expecting you to go and get a technical co-founder when you get the money. And if you haven't raised a substantial amount of money, like I'm talking millions, like million plus, 2 million plus, then the numbers you're talking about, as far as making it more of an equal partnership, I think are more than within reason. If there's like three founders, okay, then yeah, maybe, it's equally distributed, whatever. I think that was a great answer, and I'm glad you shared, your story there. Um, so you guys get together, you start working, you bootstrap, and you decide Y Combinator. That's where we're going. Did you apply once and get in? Did you apply multiple times? What was that experience?
It was actually, it was, I, th- I think my third time applying. So first time getting in. I think as part of Howdy, it was our second time applying. And it was, it's not easy because it's not like I was saying before, it's not a sexy business. It's not a platform. It's not generative AI and so on. Um, but I'm sure you've heard this before. Even it's worth going through the process, even if it's if you don't feel like it's likely that you'll get in. Maybe you don't have the technical co-founder. Maybe you're just getting started. The questionnaire itself was a valuable day to go through to think. In particular, doing it with your co-founders, is everybody really on the same page? Because you'd be surprised how many times there's a question and Jacqueline and I had slightly, subtly different answers with major implications, and it was super useful to go through it together, hash that out, get on the same page, and keep going. So yeah, the first time. I think the it was a very useful exercise. I think it's it's sometimes I wonder myself is like, what did they see in the organization? And I asked them too. I was like, hey guys, like, you know, uh, when I see Howdy, I see like a software development agency or a staffing agency, and I don't see a lot of organizations that are just like staffing agencies and that get tons of TechCrunch media and so on and PR. Um, but I think what really surprised me about the process and them accepting us as a YC company was they, especially at early stages, even with our company, even if it was bootstrapped and operating for a little while, I think what they see more is they see traction, any kind of traction, whether that's like retention for, I don't know, some niche thing, like you have high retention in some niche thing, or the whatever that happens to be, they really key in on because the business is probably going to change anyway. The idea is going to pivot a little bit. The founders are going to learn a little bit. So I was actually really impressed that the kinds of questions that they were asking were more along the lines of how are the founders getting together. One of my favorite tactics that they employed was they would rapid fire a bunch of questions and then in the middle of it interrupt me and ask both of us which one of you is the CEO, right? Because they wanted to make sure, because we came at this as, yeah, equal partners and from a bootstrap background, like which one's actually in charge here. And I thought that was really clever, because we both immediately answered Jacqueline. She's in charge. She's the CEO, right? Going back to your other point, like it's okay to give up the equity because we're both in agreement that she will decide, and we'll that's the only way you can steer a ship, right? There's no other way to make it work. So yeah, that was our experience going through Y Combinator, and it kind of culminated with when we actually got in. Some of my closest friends looking at me and like, you guys are not a tech company or like a traditional product SaaS company. Why are you guys in? So I thought that was really interesting.
Well, that's kind of what I thought was interesting about having you guys on the show, is just kind of being able to share that, albeit not the norm, but still possible to go down these paths. And then once you get the checkbox from Y Combinator, especially around the time, like you were peak of market coming in, and everyone was looking for something new and different to throw money at. And you guys ended up raising about $3 million in total in your seed round shortly after doing Y Combinator, correct?
That's
Uh,
right. Mm-hmm.
what was the fundraising process? All right, it's one thing to get accepted into Y Com. That's always an accomplishment. There's thousands of companies that apply and very few that get in. But did you wait till demo day? Did you raise before demo day? What was kind of the process and strategy that you guys used?
Yeah, that's a great question. We actually waited to just about a week or two before demo day, which I believe is the standard advice for people who go through that. It was easier for us, I have to admit, and that's at least in that particular batch or in that particular cohort. And the reason it was easier for us to raise is number one, we had a really strong story. We had really strong traction. And ironically, the best time to raise money is when you don't need it, right? So our business had started operations in 2018. We had grown all under our own power. We were profitable. We were paying ourselves. And in that situation, the 1 or 2 weeks leading up to it, the standard process, right? They reaching out to the people who, here are the investors that get the preview to demo day. And Y Combinator is brilliant in the way that they generate that demand and that urgency in reverse, where it's usually the founders who are reaching out. For those 2 weeks leading up to demo day, and then the maybe the few weeks after, thankfully there's that urgency, and so we had investors coming to us. At first, I guess the common advice is to take the money from the people who are like expedient, who are ready to give you money, ready to go. But what we noticed was that then the cap table was going to get really big, and that was a lot of overhead. So we were in a fortunate position to decide, okay, actually we're getting some indication and interest from these bigger organizations like Greycroft, who are more institutional. And so we decided in our process to actually pivot and put a little bit more effort in the firms that were offering more bigger checks. And so we actually optimized for those rather than quickly closing the smaller ones that were coming in. So we did that. For us, the way that we did our process was a little bit different because we actually tried to avoid the standard pitch deck. If for those of you who are interested, you can find my co-founders. She did a talk at TechCrunch, and it's a provocative name, but it's something like your pitch deck sucks. We actually used a video. And what we did was we would have the initial conversations with the principals or the lower level teammates. That's right, yeah. And when they were excited, of course, they're like, send me the pitch deck. I'd like to take this back to my team and so on. And that's when we would actually say, no, we're not sending you the pitch deck. Here's a link to our video that walked us through the story. And the pitch deck was pretty, here's the problem, here's the traction, here are the unit economics, here's how big, the pretty standard stuff. And we would actually just kind of push back and say, because people would reach out and say like, hey, I love that you send the video. I love the video, but really like everybody needs to have a pitch deck. Everybody needs this and that. They're not even going to look at it without the pitch deck. And, one of the funny things is that I saw during the process is how much, posturing and ego can be involved in the fundraising process. This is all credit to my co-founder, right? She completely values us and values our company. And what I watched was when she valued herself and valued us and valued our company by saying, thank you so much. This is how we do it. If you're not going to do it this way, then maybe we're not going to be able to collaborate at all. I was actually impressed, off the top of my head, something like 80-90% of people, if they see you value yourself and what you're doing, they will value you. And kind of the harder part is just having the courage to stick up for yourself in that way. And the people that really were like, this is complete blocker, they're never going to work with us because we didn't send the deck and we sent a video instead, like maybe they're not really worth the time, and we didn't need the money. So that was our process and our tactic to navigate that, and it ended up working out for us.
Yeah, it's coming from a position of power when you don't necessarily need the money right then and there, and you've built a healthy business at that point and had the flexibility to kind of say no, which ironically makes VCs be like, well, no, we're flexible, we're cool. No, we can roll with that. Guys, can we roll with that? Yeah, we can roll with that.
I think that's what's surprising, especially my background is in engineering, later as a product manager, so I definitely have the technical brain, and to see those social dynamics play out were really interesting. And it's a dating process, right? It's just as complex as dating, which I thought was really interesting.
Did you know that most founders waste days of their lives chasing the wrong investors? Well, as a founder, you know your time is your most valuable resource. Don't waste it on the investors that aren't going to write you a check. Here at Thunder, we built a free tool that identifies exactly which VCs are worth your time to pursue. We score your company against 3,500 VCs and family offices that have been vetted and are actively writing checks into companies like yours. Get your AI recommended list of investors that will look like this absolutely free by creating a free profile at Thunder.vc. You can upgrade to premium to download this list, export it to any tool you wish, and get their contact information and access the data on their portfolio companies to map out a path to warm intros and build your founder network. Sign up for free at Thunder.vc. Now let's get back to the show.
So where were you guys at post YCOM raising this round? If you don't mind sharing, like what kind of revenue were you guys at that point?
Yeah, so our first, so when we did the seed round, we were at let's see, we had about 30 developers. Quick economics for our company. Just gross numbers here. For every one developer that we have on our platform, we gross about 100K, right? So that's gross. Out of that, of course, you take salaries and benefits and taxes and so on. So we were at about 30 developers, so 30 times 100K in terms of revenue. Then after our when we started closing our Series A, that's when our growth really took off, and so we were at 171 developers on our platform. Yeah, that's I think that's pretty significant because it was only about a year. It really took off, but to be honest, I think what's interesting is it was during the height of COVID. I think COVID was a mad time because we fell in that trap, and I wonder if some of your audience fell in the trap where we thought we were brilliant at our sales and our marketing when really we just had the winds of remote work and remote teammates and the crunch for talent that were pushing us, right? Just pushing us along. And then the correction happened, right? So we had a correction where all of a sudden hundreds of thousands of some of the world's best companies, Google, Facebook, Amazon, Microsoft, just laying off people by the tens of thousands, hundreds of thousands per month sometimes. And so we, to be just completely frank, our company, our business completely did take off, which helped us put us on a trajectory for something like a Series A. Then comes a correction. And then comes like that what is it? The trough of sorrow, I guess, that you see, where you get that uptick and then, something changes in the market, or maybe maybe you found this one channel that really worked well and doesn't work forever because people also move into the channel, whatever the dynamics are. And so luckily we had really understanding investors too, right? So the investors that we have and that are on our board, we were a little bit nervous too because like that nonlinear growth stopped while the whole market was flooded with new engineers and everybody's trying to figure out what the new value proposition for a hiring platform is when now you have your pick of the litter of more affordable engineers. So why would you need to kind of solve the talent risk problem, right? It's already been solved by the market dynamics of layoffs and so on. But that's where that relationship with investors really plays in, because I remember walking into that first board meeting where we had to, it was our first quarter where we didn't have that exponential growth and we were stagnating or growing linearly, slowly. And it was nothing but understanding. It was nothing but like, here's the big picture. Hiring can be very cyclical. There are booms where people are hiring, things go lower, and we got down to very tactical, a tactical level to understand what was going on, experiments that we can run. Is it how does our market proposition change and our unique value proposition change between the height of the COVID hiring spree and a place where it's not. Now the conversation isn't hire as fast as you can. It doesn't matter how much it costs. It's like, people are looking to cut costs, save money. There's more competition. What's valuable about us there? And so that really taught me a lot about, you hear a lot of horror stories about like bad board meetings, surprises during, those tensions and conflicts when the board isn't being managed correctly. You really have to choose your investors correctly, right? Index on that cultural fit and how things are going to work when everybody's happy, things are easy. But when things are challenged, when it's a challenging instance, then those values really start to come out, and it's hard to it's hard, but not impossible to feel a little bit of those things beforehand.
No, and I think it's funny to see you go full circle, to have the fears of having a board and seeing that play out at companies you were working at and choosing to bootstrap, to then go on and kind of follow against that narrative voluntarily, but seeing it actually work on the positive. But I think all that credit is really owed to you and Jacqueline, your co-founder, in the sense of building a sustainable company. Like, I bet everyone was happy to walk into that board meeting and still see growth.
Yes.
Maybe not exponential, but there's just the fact that you were not tanking like everyone else in their portfolio. Especially like I saw a lot of staffing companies just eating dirt. It was tough to compete in that market. I fortunately had some friends that sold right at the peak and got out, and they made a killing, and then their businesses really suffered shortly after. But if you build a great company, there's always some value there, and that sounds like that's how you guys have preserved yourselves in that state. But did you raise the Series A before the collapse of the market or after the collapse of the market?
It was really during the writing was on the wall. We could see that things were happening, that things were difficult, and so on. So I think that also was what sort of pre-vetted those conversations. Like we built this successful business. It was profitable. The unit economics were there. I think we were starting to see that we had the COVID wins, and yet the story that we had told, the experience that we had, the way we had built everything, still gave confidence to our investors, and our investors had a lot of I don't a vision, I should say, because they were also aware that in the conversations that we were having, we were preparing for a storm. And so our conversations were, you guys are profitable, but would it be better to have to be capitalized for a recession in the United States, right? So we can see that you guys are working at a unit level. What if we built a war chest or a buffer to get us through 2 years or 3 years of tough times? And the reason I think they had that foresight was because our company was continuing to grow, even though at a lower pace. On the flip side, what they told their portfolio companies was directly harmful to us too. They were telling everybody, stop hiring, don't raise salaries right now, don't give out huge bonuses right now, hold on to your money. And so they could see both sides of the coin, where they see the writing on the wall for what could happen here. They're telling most of their portfolio companies to hunker down, and then they come to us and they see how that impacts us directly, but they know what it's like when the winds shift again, right? And really, it was a bit of a blessing in disguise, because it focused us on learning to sell and market this product, our product, in a market where there's in a market where the hiring is softer, where it's pickier, where the bar is much higher in terms of talent and retention and so on. And over the last few quarters, we've managed to really overcome those. And so I'm happy to report that although we're not back to the growth rate that we wanted, pre-COVID or during that COVID madness, we have twice as many customers as we had before. So we're in terms of just sheer size and revenue, we're back up to where we were pre all those massive layoffs. So the company, and we can sell ourselves and market ourselves much better. So overall, we're much healthier. But it was definitely like I don't know. It was like a one of those like self reinvention moments, right? Where you realize I've got to exercise, I've got to eat healthy, I have to go to the gym regularly, and it's painful and it's hard, but ultimately, a year and a half later, you're fit, you have more energy, you feel more attractive, and so on. So we had to go through that ourselves.
I appreciate you sharing that and sharing those insights. And I think, at this point, what advice do you have for founders that are looking to raise and seek outside capital at this point?
I'll give the advice that ended up working for us, and I know it's not possible for every business, but it really really helped us to set aside the thought about fundraising for a moment, right? Kind of put your bootstrapping company hat on, and how do you build a business that is profitable from the beginning? Again, I know that's not completely possible. However, there are some proxies that are very useful, and that's traction or letters of intent, and things like that, like with subscribers, whatever it happens to be, that shows that there's value in what you're trying to build. Um, if you can, yes, be profitable. Don't be beholden to needing the money to accomplish your goals. The other thing I would say is it's at least for me and my co-founder, who didn't come from an entrepreneurial background, who didn't come, we weren't very connected. I was a model employee for so long. I had a lot of uh, reservations about pushing back against suggestions from investors, um, or saying no, or rescheduling and things like that, right? Like, and the reason was it kind of came from a scarcity mindset, where I was used to saving tons of money. My parents showed me to save tons of money. They were also very risk averse. No entrepreneurs in my family, and a scarcity mindset, I think, can it can make it so that people don't value you, if that sounds right. So it was kind of a learning experience for us. So I'm sure there are people in your audience who maybe have similar backgrounds, who are bootstrapping their companies and feel like, okay, I don't have the guts to send a video when people are asking me for a pitch deck. I don't have the guts to ignore investor advice. This is another one where this one kind of bit us a little bit, and that is where we um, we sort of assume that the advice that our investors give, because they have so much experience, they have very important, very successful careers themselves, and are very intelligent people, which that the advice that they give must be correct, or we have to integrate it in in some way. But we made the mistake. Some of the conversations we had with some investors tried to spin or figure out a way to spin our business to become more platform oriented, more technology oriented, right? And we actually made a few initial investments thinking, okay, this is going to make us more appealing to investors, and which is going to make our lives easier, and so on. And we ran experiments like that, and we had investments like that. We had a bit of a roadmap in our product to look more attractive to investors. And what we found out is, after those investments, after those initial releases, it didn't really make a difference. It didn't move the needle, right? And I wish that in those instances, I had more confidence in what our vision was and what our strong opinion was, finding that balance. And we would have stuck to our guns, and we would have said, look, we're never going to be a SaaS product. We're not going to try to market it that way. We're not going to build a roadmap that way. We're not going to build a product-oriented engineering team like that. Spend millions and millions of dollars on uh, product managers and UX designers and so on. We're going to, like you said, use tech where it makes sense. Invest in people and processes more than we're going to invest in product-oriented technologies and so on. And I wish we had more of that courage, relying more on our instinct and the things that we were seeing on the ground, rather than over index on investor feedback. So I think that would be one piece of advice there.
No, I would completely agree. I think when you're at a stage as a founder where you maybe haven't figured things out, that advice can be very impactful, either negatively or positively. And then when you kind of hit a certain inflection point, your business is working, taking that kind of advice could be deadly. So
Yes, that's right.
appreciate
That's
you
right.
sharing that. So as we wrap, Frank, what's the best way for people to learn more about you and Howdy?
Absolutely. So you can find our website at howdy.com. So go ahead and check that out if that's something that's interesting to you. Hiring people around the world, save some money, find really talented people. If your audience is interested in how we bootstrapped, how our families dealt with it, how we budgeted, please feel free to reach out to me at my email address. That's the letter F at howdy.com. Also, reach out to me if anybody in your audience is interested in reading Y Combinator applications or doing mock interviews, things like that. Super, super happy. And if you yourself are raising money right now and you need something like intros and so on, please send me a little blurb. And if my investors are interested, I'm happy to make that connection. But I'll have so any way that I can help in that way, happy to do it.
Awesome. Frank, that's phenomenal. I really appreciate that. We'll make sure that we'll leave your contact information for people to reach out to you in the show notes. But it's been a great show. It's been great to have a technical co-founder kind of share their reasoning for joining and hopefully inspire founders to be a little bit more conversational and kind of more forthcoming with these opportunities with technical co-founders. So thanks for being on the show, and I look forward to getting this out to our audience as soon as we can.
Appreciate it. Yeah, it was a blast. Thank you.
Thanks for listening to the show today. We hope you learned something valuable. And if you did, be sure to let us know in the comments or by hitting that like button. And if you're a founder looking to raise capital, then join us at Thunder.vc. We provide a free tool to help you identify which VC, family offices, or lenders are the best fit for you using our AI. It will save you a ton of time from chasing the wrong investors. And since launching our free tools, founders that have joined our network have gone on to raise over $1 billion in financing. Again, you can find these free tools at Thunder.vc. And as a reminder, we release new episodes every week. So stay informed by subscribing to our newsletter at join.thunder.vc. Again, that's join.thunder.vc. And if you or someone you know has recently raised a round and want to share your story, please email me at jason@thunder.vc. And that's our show. We hope you enjoyed it, and we see you next week.